Hello, my name is Kelly Gadison, and we're here today to talk about adjusting entries and improved financial forecasting. So, just a little background and introduction. We're working with a company who has had some misrepresentation of what they expected from a forecast related to their inventory. So, we're going to be looking at inventory transactions and recording materials cost. Then we're going to look at the adjusting entries and the effects that this has to the cost of goods sold, as well as the forecast. And then lastly, we'll look at some suggestions to forecasting in the future. So when we look at a company purchasing raw materials, they're recorded in as inventory, which results in a debit to raw materials. Typically, a company will pay for raw materials on a credit basis, which would result to a credit for accounts payable. As the company uses those materials in production, it will transfer over eventually to finished goods. Once the item is sold, then the cost of goods will finally be recognized and the item is removed from inventory. So just moving through those processes related to both the journal entries as well as the T accounts. As you can see on the screen, we have the debit to the inventory, the credit to accounts payable because this was purchased on credit. Then we see the raw materials debit as well as the cost of goods sold, recognizing that expense of the raw materials post-sale. That's on the journal entry side. On the T account side, you see these same accounting principles but used in the T accounts. Now we move to the adjusting entry and the effects that it has to the cost of goods sold and forecasting. So when we look at adjusting an entry, we're looking at it's in an interim period, right? So this is the end of a quarter, which would be anything that's not annual or fiscal year that we're using to account for things. So this is the interim period. It's the end of the quarter, and it's very relevant to people who are trying to make decisions about investing, about when we're reporting public numbers to the street and impacting who's going to be willing to invest or stay investing. So we want to be sure that these adjusted entries are there to be providing a clear picture of what actually has transpired over that previous interim period for this instance on a quarter. Then we want to look at, in this case, there was $350,000 more that was spent on supplies, specifically insulation for refrigerators, than what was forecasted. So that created a shrinkage or a less inventory than what was expected, still there, but also it also has impacts to the cost of goods sold. So an overage of $350,000 to our cost of goods sold. So you see here again, we have the journal entry, which demonstrates that inventory shrinkage expense as a debit, then a credit or a decrease to our inventory to reflect that shrinkage, and then the same in our T accounts. So then as we look at suggestions to forecasting in the future, obviously the purchaser has some strong concerns about what the buyers are buying, the cost of what they're buying it at, and then also the utilization and how we can better forecast that in the future. Market prices are obviously going to fluctuate, so we have to look at those things. But there are some other suggestions that we have that may make this a little bit better for the company in being able to predict utilization. So technology is the first one that I want to talk about, and then inventory accountability. So when we think about the use of digitalization in business today, being able to scan inventory at the dispense stage would indicate that utilization is happening. Then being able to track that utilization digitally through weights or through the amounts that are dispensed would be helpful in being able to understand where that shrinkage may be happening or where we may have a change in the product itself that's requiring more inventory or more product than we expected to use as a supply. The next piece is really related to shrinkage controls. So as we look at how we're utilizing products. It's great to be able to have the inventory scanned. It's great to be able to have the digitalization of the utilization, but then someone has to check that. So if we are finding that we're having extreme shortages that we were not expecting, then we would move to a daily quality check. Also, user control. So who is it that's able to dispense the inventory and supply, and being able to have a little bit more control at this level, which is really in the weeds, but certainly helpful as we're looking at being able to be accurate in the amounts that we're forecasting. Then the last piece is really going back to the beginning. So we use those historical actuals that we find from our P&Ls to help us with the foundation for what we're going to be able to forecast as the future. However, we know that there's market fluctuations in the price, but also in the way that the products are built. And so we have to adjust with those to ensure that our forecasting is able to be predictable in the future. I thank you so much for joining me today. I'm happy to take questions. My email is here. And again, Kelly Gadison signing off on adjusting entries and forecasting. Thanks.